Most people do not get hurt in retirement because they ran out of opinions. They get hurt because they ran out of timing. That is one of the least glamorous truths in finance, which is probably why almost nobody teaches it well. People spend decades being told that retirement is about saving enough, investing wisely, choosing the right allocation, and maybe deciding when to claim Social Security. All of those things matter. But once you get close enough to retirement, or once you are already living inside it, the great hidden force is not only return, it is sequence. When income arrives, how income is labeled, which deduction survives, which one phases out. When Medicare is looking backward instead of forward, when a Roth conversion helps, when a Roth conversion hurts, when $1 extra is not really $1 extra at all. But the beginning of a chain reaction, that is the part most people never see until the bill arrives. They think taxes in retirement should naturally go down because work has stopped. That sounds clean. It sounds intuitive. It also happens to be one of the most expensive assumptions ordinary people make. Retirement taxes are not simply wages replaced by lower income. Retirement taxes are a geometry problem. Social Security, IRA withdrawals, pensions, capital gains, RMDs, bonus deductions, Medicare thresholds, state taxes, and the silent loss of deductions all begin interacting at once. The result is that a retiree can feel as though he earned only a little more, yet somehow lost far more than expected once the full tax and premium machine finished recalculating him. That is why I care so much about this new 2026 framework. Not because I enjoy tax tables, I do not. I care because a lot of people are looking at the 2026 changes in exactly the wrong way. They see a bigger standard deduction. They hear about a senior bonus deduction. They assume relief has arrived, and then they stop thinking that is dangerous. Relief in the tax code is rarely flat relief. It helps some households cleanly, helps some households temporarily, and helps other households just enough to lure them into forgetting the phaseouts, the cliffs, and the interactions that do the real damage. I have spent a great deal of my life watching people prepare for retirement as though retirement were the end of financial complexity. In reality, for many households, retirement is the beginning of a more delicate form of complexity. While you are working, the tax system is noisy but at least familiar. Wages come in, withholding comes out, payroll systems do much of the mechanical work for you. In retirement, you become your own timing department. Every withdrawal, every conversion, every deduction, every premium, every bracket threshold, every year, end move begins to matter in a way many people do not appreciate until the first few mistakes have already been made. That is why I want to tell this story the right way, not as a list of bracket updates, as a warning about hidden tax geometry, because the worst tax bills in retirement are usually not obvious tax bills. They are stealth taxes. The extra money you lose because one threshold triggers another threshold, the Social Security that becomes more taxable than you expected, the Medicare premium that jumps because of a 2-year old event you forgot still mattered, the deduction that looked generous in the headline and then quietly starts shrinking once your income edges over a line, the state and local relief that sounds massive until income phase-out math starts clawing it back. People love to ask, what is my tax bracket? That is not the wrong question. It is just not enough of a question. The better question is, what tax system am I actually entering once all the parts begin touching each other? That is the real question. Let us begin with the part most people are likely to celebrate too early, which is the larger deduction framework for seniors. On the surface, this looks wonderful. For 2026, the baseline standard deduction rises. Then for taxpayers age 65 or older, there is an additional senior bonus deduction layered on top. Then there is the age-based additional deduction as well. Once you stack these correctly, the shield can get large enough that many retirees will feel for the first time in a while that the code is actually working in their favor. And for some of them, it will. That part is important to say. I do not like pretending that every tax change is a trap that is lazy and emotionally satisfying. But it is still lazy. For a retiree with moderate income, this can be genuinely valuable. If a married couple is over 65 and filing jointly, the combined standard deduction, senior bonus, and additional age deduction can create a very substantial shield before taxable income even begins. For a single retiree over 65, the same logic applies on a smaller scale in real life. That means some households can protect more of their ordinary income than they could before. For others, it creates extra room to do smart planning moves that would have been more expensive under older thresholds. That sounds generous. It is generous. But now we arrive at the dangerous part, because the public is usually excellent at noticing the existence of deductions and terrible at studying the conditions under which those deductions start disappearing. This senior bonus is not a pure gift with no strings attached. It phases out. Once income moves above certain levels, the system begins taking it back, and that is where retirement tax planning stops being about relief and starts being about timing. I want you to think about how this works emotionally. A retiree may look at the larger deduction and feel safer than before. He may think the system is now more forgiving. Then he sells appreciated assets, or converts too much to Roth, or has one unusual income year, or takes distributions carelessly, and suddenly the very deduction that made him feel safe starts shrinking. He loses part of the bonus. Then he discovers that the increased income may also change how much of Social Security becomes taxable. Then, depending on the year and the amount, that same income can influence Medicare premiums later through the 2-year look-back. One move, multiple consequences. That is the geometry. This is why I keep saying taxes in retirement are not only about rates, they are about stacking effects. A retiree does not live inside one tax rule. He lives inside an ecosystem of tax rules. That is why the senior deduction is best understood not as a finish line, but as planning space. Planning space is one of my favorite things in finance. It gives you room. Room to move money, room to keep more of the next dollar, room to avoid being pushed into a bad year by your own lack of foresight. A good planner looks at a new deduction and does not say wonderful. I can stop worrying, he says, interesting. This gives me a wider lane in which to drive carefully. That is the right mindset. Now let us move to the Social Security washout effect, because this is where retirees get hurt in ways they do not see coming. Social Security taxation is one of the uglier pieces of retirement finance because it feels illegitimate even when it is fully legal. People work, pay into the system for decades, receive benefits, and then discover that those benefits can become taxable based on other income. Up to 85% of benefits can be pulled into the taxable calculation depending on the rest of the income picture. That makes people angry. I understand the anger, but anger is less useful than understanding, and the understanding now has to incorporate the new deduction structure. The Social Security rules themselves have not suddenly transformed into something clean and noble. What changes is the interaction. The new senior bonus can act like a temporary shield, helping offset part of the tax drag created when Social Security becomes exposed to other income. That is why some people are calling it a washout effect. It can soften the bite. It can keep more of the income stack from spilling into taxable territory. It can create the sensation that your Social Security is more protected than before. For some households, that is absolutely true, but then comes the trap. The shield is not stable if your income is not stable. For every dollar you move past the phase-out threshold, the senior bonus begins getting reduced alone. That reduction may not look dramatic. A few $100s of lost deduction does not sound like a crisis, but retirement is where small losses become multipliers. That smaller deduction can mean more taxable income. More taxable income can mean more of Social Security exposed. More exposure can push you closer to premium issues or reduce the comfort of what you assumed was a safe income level. That is why one extra $5,000 decision can feel much bigger than $5,000 once the whole stack is recalculated. This is the part I wish every retiree understood. The tax code does not always hurt you in obvious chunks. Sometimes it hurts you in conversion layers. You lose one thing, which weakens another thing, which exposes a third thing. And by the end of the process, the total damage is much larger than the first number suggested. That is why I hate casual withdrawal planning. A lot of retirees approach distributions as though money were money no matter where it comes from. It is not. IRA dollars are different from Roth dollars. Capital gains are different from pension income. Social Security is different from all three. The order in which you pull matters because the order changes the rest of the stack. That is why the washout effect is so powerful conceptually. It reminds you that what matters is not only how much you receive, it is how the receipt interacts with everything else already on the page. Now, let us talk about SALT relief, because this is the sort of thing that gets presented like a giant victory and then quietly becomes much more conditional than the headline implied. For homeowners in high-tax states, the expansion of the state and local tax deduction cap looks like a major gift, and again, for some households, it genuinely is. Since the earlier cap, many people in high-tax states have felt squeezed in a way that seemed politically and economically absurd. Bigger property tax bills, state income taxes, and a deduction cap that did not begin to absorb the real burden. So on the surface, a much higher cap looks like a massive release of pressure. In certain cases, it will be. But only in certain cases, because once income climbs over a specified level, the IRS starts reducing the relief, not necessarily eliminating it immediately, but reducing it. This is the recurring pattern. The code offers generosity with one hand and sends a quiet accountant with the other hand to begin retrieving part of it from anyone whose income is high enough. And while there is still a floor and while the expanded SALT opportunity can be very meaningful, the planning lesson is the same as everywhere else in this discussion. Do not celebrate a deduction before you understand how it decays. That is one of the simplest rules I know in retirement planning. Decay matters as much as existence. A deduction that exists on paper but begins shrinking as your other decisions accumulate is not a static gift. It is a variable. And variables require timing. This is especially true for people who own businesses or pass-through entities and still have access to state-level workaround strategies. When people hear that SALT relief is back, they often stop there. But the serious planner asks a better question: is the ordinary federal deduction path my best route, or is there still a more intelligent way to structure the burden through the business so that the cap matters less? The public loves one-size-fits-all solutions. Real tax efficiency is rarely one size. Which brings me to the part that may hurt people the most emotionally, because it feels so unfair after the fact. Medicare IRMAA. IRMAA is one of the cleanest examples I know of how retirement punishes people who think only in the current year. Most households look at Medicare premiums the way they look at almost every other bill. What is my income now? And what should I be paying now? That is not how this works. Medicare, through IRMAA, uses a 2-year look back. That means your 2026 premiums are being shaped by older tax year numbers. A one-time spike in income from 2 years ago can still be reaching into your current life and grabbing money out of your pocket. That is ugly. It is also 100% predictable. If you understand the rule, I care a great deal about predictable ugliness. Because predictable ugliness can often be managed: a Roth conversion, an asset sale, a business event, a large distribution, a one-time windfall, even something emotionally painful like the death of a spouse can produce tax. Year changes that keep affecting Medicare premiums later. That is why people sometimes feel as though they have been ambushed. The event is over, the cash is gone or already allocated, life has changed, and then the premium notice arrives based on older numbers that no longer reflect the present. This is why retirees need to think across years, not within years. It is not enough to ask, what does this do to my 2026 taxes? You must ask, what does this do to my 2028 Medicare premium? What does this do to my future Social Security exposure? What does this do to the disappearance of deductions I thought I still had? And what appeal mechanisms or correction forms exist if my current reality is no longer reflected in the look-back data? That last part matters too. A lot of people accept IRMAA as though the notice were a moral verdict. It is not. Sometimes it is just stale data applied to a changed life. Widowhood, retirement, work stoppage, and other life-changing events can justify a response, but you have to know the mechanism exists and you have to use it. The system does not reward silent suffering. It rewards the people who know which form to file. And this is one reason I say taxes in retirement are less about accounting and more about orchestration. Accounting tells you what happened. Orchestration decides what happens next and in what order. Now let us talk about the 4-step action plan implied by all of this, because I never want a retiree to walk away from a discussion like this feeling only anxiety. Anxiety is cheap. Structure is useful. The first thing is to audit income with more intelligence than most people do. I do not mean count it. Everyone counts it. I mean classify it, time it, and understand its interaction profile. Which dollars are rigid, which are discretionary, which can be shifted, which can be delayed, which can be converted, which can be reduced through planning, which are silently costing you more because of what they trigger elsewhere. That is the real audit. A retiree who merely knows total income is halfway blind. A retiree who knows the character of each income source is beginning to see. The second thing is to defuse the Medicare bomb before it explodes. That means not only checking the current year, but checking the 2-year look back: what happened, what will still count, what can be appealed, what is already baked in, which one-time spikes are still haunting the future. So many people get hit here, not because the rule is hidden, but because they never learned to look backward while planning forward. The third thing is to maximize itemization logic and state tax strategy where it truly pays, not merely where it makes a good headline. Some retirees in high-tax states will benefit enormously. Others will discover the relief is more partial than they hoped once the phase-outs start nibbling. And business owners have a different set of tools available than pure wage retirees do. That matters. Context matters more than slogans. The fourth thing is income shifting. Income shifting is one of the most powerful and least emotionally satisfying tools in all of retirement planning, which is exactly why so many people ignore it. It means moving dollars from one category, 1 year or one timing window into another, more favorable category. Year or window Roth conversions are part of this. Qualified charitable distributions are part of this donor. Advised strategies can be part of this. Timing capital gains can be part of this. Choosing what account to spend from can be part of this. The public likes to think of retirement as spending down a pile. Sophisticated retirees understand that retirement is often about choosing which pile gets disturbed first and why. That is what keeps stealth taxes from multiplying. Now, I want to say something that may sound harsher than people expect from a discussion about retirees. Retirement does not excuse laziness. In fact, retirement punishes laziness more elegantly than working life does. When you are working, you can sometimes out-earn mistakes for a while. Another salary cycle comes in, another bonus comes in, another promotion comes in. The machine keeps feeding you enough income to hide structural sloppiness. In retirement, the machine changes. The margin for waste narrows. The sequencing of cash flows matters more. The tax stack becomes more sensitive. The stealth costs become more visible. The government becomes more interested in what category each dollar belonged to and when it arrived. This is why so many people feel poorer in retirement, even when they are not technically poor. They are leaking through tax inefficiency, leaking through bad timing, leaking through Medicare lookbacks, leaking through overly simplistic withdrawal strategies, leaking through failure to protect deductions, leaking through lack of planning when a spouse dies, when a windfall lands, when an account gets too large, when RMDs are approaching, or when a one-time event distorts the whole picture for years. I despise leakage, especially predictable leakage. And that is what most of these rules create if ignored. So, what should you remember most from the 2026 changes? Not that the IRS gave you bigger deductions, not that Social Security somehow became friendly, not that SALT relief is a miracle, not that Medicare suddenly became meaner. Those are partial truths at best. The deeper truth is this. Retirement tax planning is now even more obviously a game of coordination. The senior bonus deduction is useful, but only if you understand the phase-out geometry. Social Security washout protection is useful, but only if you understand the stacking effects. SALT relief is useful, but only if you understand the income clawback and the alternatives available to your structure. Medicare relief is possible, but only if you understand the 2-year clock and act quickly when life changes. That is the game, not one rule. Interaction. I have always believed that people do best in finance when they stop asking, what is the rule, and start asking, how do the rules collide? That question is more work. It is also more profitable because the biggest mistakes are rarely made in one rule. They are made in the collision between rules. A retiree crosses one threshold thinking the cost is small, and only later discovers he did not merely cross one threshold. He weakened a deduction, increased taxable Social Security, and invited a future premium jump. He did not make one mistake. He triggered a chain reaction. That is the thing you must avoid. The market can hurt you, yes, but the market hurts everybody from time to time. Tax geometry hurts selectively. It hurts the unprepared more than the prepared. It hurts the inattentive more than the careful. It hurts the people who treat retirement like a static phase more than the people who treat it as an active planning environment. That is why I am saying all of this so plainly, not to scare you, to remind you that the money you keep in retirement is often decided less by what you earned and more by what you understood soon enough to time correctly. That is the real tax-efficient retirement, not lower tax rates by accident, lower leakage by design.